All right, Ticker Shock listeners, Dave here. Today, we are discussing the ticker shock that's hitting the chip giant NVIDIA, ticker NVDA. Let's dig in. So, what's the big shock we're dissecting today? Well, the dominant market narrative around NVIDIA is one of unparalleled leadership in AI and generative AI. Everyone sees the robust demand for their GPUs in data centers, fueling strong investor confidence. But what if a significant headwind emerged? What if a new, substantial tax or payment policy hit one of their biggest growth engines? That's what we're going to explore. Specifically, we're going to crunch the numbers on a hypothetical scenario, a potential rumor, a 15% payment to the US government on NVIDIA's chip sales to China. What would that mean for their bottom line? First, let's understand NVIDIA itself. This company, NVDA, is a pioneer in accelerated computing. They started with PC graphics, but they've grown far beyond that, now powering scientific computing, artificial intelligence, data science, autonomous vehicles, and even digital twin applications. Their GPUs are the muscle behind gaming, hyperscale AI training, massive data centers, and professional visualization. It's a truly diverse and impactful business. Now, looking at where NVIDIA makes its money, their latest annual revenue clocked in at a staggering $148.51 billion. And the gross margin, an impressive 70.11% in the trailing 12 months, showing just how profitable their core business is. When we break down that revenue by segment, it's clear where the power lies. A massive 88.7% comes from their data center segment. The rest, about 11.3%, is from other areas like gaming, professional visualization, and automotive. Geographically, it's pretty evenly split, with 53% of revenue coming from outside the United States and 47% from within the US. This global footprint is important, especially when we talk about that potential China impact. So, with that background, let's get into the nitty-gritty of how this hypothetical 15% payment on China chip sales could really hit their earnings. We've got a step-by-step breakdown here, and it's quite illuminating. Step 1. We need to estimate China's contribution to NVIDIA's overall revenue. While not explicitly stated by the company, China is a significant market for NVIDIA's data center segment. Given that outside United States accounts for 53% of total revenue, we're estimating China's share to be approximately 20% of NVIDIA's latest annual revenue. Step 2. Let's put a number on that. Based on the latest annual revenue of $148.51 billion, 20% of that translates to an estimated annual revenue from China of about $29.7 billion. That's a huge chunk of change. Step 3. Now for the hit. If there was indeed a 15% payment on those China chip sales to the US government, that means an annual payment of $29.7 billion multiplied by 0.15, which comes out to $4.455 billion. Just imagine nearly $4.5 billion flowing out annually due to this one potential policy. Step 5. Companies report quarterly, so we need to convert that annual payment into a quarterly impact. Divide $4.455 billion by 4, and you get an estimated quarterly impact on NVIDIA's financials of about $1.114 billion. That's how much less cash would be hitting their bottom line each quarter. Step 5. To understand the percentage impact, we need a baseline. We estimate NVIDIA's baseline quarterly net income. Using their latest annual revenue of $148.51 billion and assuming a conservative net profit margin of 55%, given that impressive 70.11% gross margin and strong free cash flow, the estimated annual net income is around $81.68 billion. So, on a quarterly basis, that's roughly $20.42 billion in net income. And finally, step 6, the big reveal. That estimated quarterly impact of negative $1.114 billion when measured against their $20.42 billion quarterly net income results in a percentage change of roughly negative 5.55%, which will round to a negative 5.5% on quarterly earnings. That's a noticeable hit, folks. Now, a quick note on confidence here. Our estimate for China's revenue share isn't explicitly detailed by the company, so there's some inherent uncertainty there. However, the 15% levy itself is clear and quantifiable, which helps reduce the overall uncertainty regarding the impact. We're looking at this potential impact with a confidence interval of roughly -4% to -7%. So, the big question is, does this hypothetical 5.5% earnings hit justify a significant move in the stock price? Let's turn to valuation. Now, remember, the numbers I'm about to share are based on sophisticated models, and the data comes from finviz.com, a great resource for financial insights. We're looking at two primary valuation methods here. First, the discounted cash flow, or DCF model. This model projects a company's future free cash flows and discounts them back to today's value. Our base case DCF value, before factoring in this potential headwind, sits around $142.40 per share. This base case represents a DCF valuation that doesn't account for the new hypothetical impact. When we factor in that projected 5.5% quarterly earnings impact, our expected case fair value comes in at approximately $134.56 per share. This expected case value is directly calculated by applying that minus 5.5% impact to the base case. In a worst-case scenario, if things got even tougher, we could see that fair value drop to about $132.43. But if this rumor never materializes, or if the impact is less severe, our best-case scenario still puts the fair value around $136.70. Then we look at the PEG ratio-based valuation. This is a simpler method that takes into account a company's growth rate in relation to its price-to-earnings ratio. Using this method, NVIDIA's fair value is estimated to be around $147 per share, indicating a strong growth premium is already priced in. So, tying it all together, if this hypothetical 15% payment on China chip sales were to become a reality, our analysis suggests an expected fair value closer to $134.56, a noticeable step down from our unimpacted base case. The potential downside in a worst-case scenario, considering the full brunt of this impact, could push the stock towards $132.43. However, the PEG ratio, reflecting NVIDIA's growth trajectory, suggests a higher potential. It's a complex picture, but this exercise helps us understand the potential price levels at play if such a rumor were to gain traction. It's an investigation into how even a seemingly small percentage impact on revenue from a specific region can ripple through a company's financials and ultimately affect its valuation. And that brings us to the close of another Ticker Shock episode. Now, a crucial disclaimer, folks. This analysis is for informational purposes only. It is not financial advice. Until next time, stay sharp, stay informed, and happy investing.